You have two types of companies in the world, private companies and public companies. What is the difference between the two? As you know, a company is made up of shares, which indicates ownership. In private companies, shares are typically held by few people, such as early investors, founders, the management team, and so on. In a public company, shares are held and can be traded by the general public via a stock market or stock exchange. For this to happen, its shares need to be somehow listed on that stock exchange via something called a listing. An example of a stock exchange might be the London Stock Exchange here in the UK or the Nasdaq Stock Exchange in the US. So why do companies choose to list on a stock exchange? Well, for one, it could be a way for a company to raise lots of money from the public through an IPO or an initial public offering. Second, it can put that company in a shop window, so to speak, giving it exposure to a wider market or audience. Third, it offers early investors liquidity, as listing on a stock market means that early investors or founders can sell their shares to external parties. Companies that list on the stock market have to prove they are robust, healthy, and must also jump through several hoops such as extensive due diligence, independent auditing, and scrutiny. It is seen as a big achievement. Today I'm going to go through 4 main ways a company can list on a stock exchange. I'm going to also relate each method with real life examples so you can see what happens in practice. Before we begin, my name is Kieran King. I'm an investor, analyst, and have run several businesses in the past. I do these financial education videos as I enjoy teaching and learning. If you enjoy my content, please do subscribe to my channel for more. Anyways, enough of the chit chat. Let's dive in. The most popular way a company can list its shares on a stock market is through something called an initial public offering, or an IPO. This is where a company sells new shares to the public in exchange for funding. As an example, let's look at Facebook. Everyone knows Facebook. Facebook launched an IPO in 2012 and listed on the Nasdaq Stock Exchange in the US. Before they did this, they worked with a number of advisors and investment banks to help prepare the company for a listing and decide what price per share it would sell at and find investors to ultimately invest. In the end, they decided that they would issue around 420 million new shares at a price of $38 a share, and they succeeded in raising about $16 billion. That $16 billion was invested into tech development, marketing, and the usual stuff required to grow a business of that magnitude. Now, when it comes to IPOs, the critical point is making sure that the share price a company sells shares at is accurate to the value of the company. If it's too high, IPO investors will potentially lose money as the price may fall below what they paid immediately after the listing. If it is too low, the company has potentially missed out for more funding for itself by underselling its value. Now, if anyone has followed the Deliveroo IPO recently, you can see how its shares were overvalued at IPO, and in the first day of trading, it lost like 26% of its value or something like that. The next way a company can list is something called a direct listing. This is very similar to an IPO with one key difference. No new shares are issued, and thus no new money is raised. A recent example would be Coinbase, the cryptocurrency exchange platform that listed on Nasdaq last month. They simply took all their shares and put them on the market. As no new shares are issued, there is no need to set a price per share. Instead, when the shares list, the public simply starts trading those shares at whatever price they feel fit. Some say it is a more natural, democratic, and less pressurized way of listing on a stock market. The next method is known as a reverse takeover, an RTO, or a reverse merger. They used to be a popular thing in the 80s or 90s, however have decreased in popularity in recent years. It works when a private company buys the majority of shares in a public company and thus ends up controlling it. The original private company shareholders then go through a process of exchanging their own shares with those of the public company. So why do people go through this route? Well, it is seen as a very fast and easy way for a company to list. As it essentially piggybacks over the compliance and legal work done of an already listed company, it can bypass a lot of those activities and make the process faster. However, unlike an IPO, no new funds are raised in this process. A major example could be in 2005, where the New York Stock Exchange was acquired by Archipelago Holdings to form the NYSE Group. New York Stock Exchange was listed, Archipelago was private but found funds to buy most of the New York Stock Exchange shares, and the new entity was renamed NYSE Group. Lastly, we have something called Special Purpose Acquisition Companies, or in short, SPACs. SPACs have been around for a long time, however they have recently become very popular, particularly in the US. SPACs are effectively blank check companies, meaning there is not much in it in terms of business plans, and investors don't really have a clue what the SPAC will do with the money. They are literally a shell entity, yet they are formed for the sole purpose of raising funds and then using those funds to acquire other companies in certain sectors. For example, let's look at Virgin Galactic. Richard Branson wanted to list his space tourism company Virgin Galactic, but wanted to bypass the traditional IPO route that involves heavy costs and can take a long time. A guy named Chamath Palihapitiya owned a particular SPAC that was listed on the New York Stock Exchange. He and his investors decided to invest $800 million into Virgin Galactic to acquire it. Virgin Galactic, in being acquired, then merges with this SPAC and forms a listed entity. In many ways, it is like the reverse of a reverse takeover. Rather than a private company acquiring a public company, it is an already public company acquiring a private company to take it public. So there you have it, 4 main ways a company can potentially list on a stock market. As always, I'd love to hear what you think in the comments, and if you enjoyed this video, please subscribe to my channel for more. Take care everyone, and I'll see you all soon.